The fourth quarters turn out to be, well, if you look at the Nifty 50 as we analyzed today, better than average quarter for India Inc., with certain sectors like cement and construction posting healthy growth in the first 3 months of 2018. What's also encouraging is the healthy guidance numbers given out by certain specific firms. But if you look at the broad-based numbers, Q4 ended up resulting in FY18 not having a double-digit growth. The question mark only is, does that give us a base which could catapult the earnings to a 20% odd optimism that everybody is working with? Let's try and find out if Suhas Harinarayanan believes that that number could turn about. He's the head of institutional equity research at JM Financial Institutional Securities. Typically tends to join us for these earnings conversations once every 6 months. Suhas, good having you. Thanks so much for taking the time out. And happy with what Q4 was, or were you disappointed?
Yeah, I think just as in every quarter, I think one has to do a lot of chops and splits and then try to analyze the numbers. Headline numbers, definitely bad, because when we looked at one particular parameter we look at is beats to misses ratios. See, while there is a Nifty 50, we have a broader coverage of about 155, 160 stocks, and if you were to just look at the 155 stocks, how many stocks are beaten versus how many stocks are missed. If you do that kind of a ratio, this has probably been one of the worst since Q2FY17 if you ignore the pre-GST quarter, right? So to that extent, this has not been a great quarter. And if you look at headline numbers, there's been a decline in profits, right? Whether it's Nifty 50 or the broader universe that we look at. So which is why I said I think there are, one needs to, look at the numbers after splitting and chopping. So I think there are basically 4 numbers. As I said, the headline numbers don't look great. The beats to misses ratio is probably one of the worst. One is revenues have beaten expectations. Revenues have beaten handsomely, in fact. Margins, though, have been a steep disappointment. Thirdly, this quarter just had too many one-offs. Even if you exclude the bank write-downs, if you include the bank write-downs and the adjust for the one-offs, probably the numbers have actually beaten. But then you'll have to believe that the one-offs are one-offs, right? Maybe they don't come back, but you have to believe that the bank write-downs don't come back again. If you believe that, bank write-downs are also, this is probably one of the last few, maybe 1 or 2 other quarters more, then you could actually end up with the kind of, the 20% number that the market and the street is looking at for FY19. So as I said, this is particularly, headline numbers have not been great at the profit level.
Do you believe that these are one-offs for the banking space as well?
Difficult to say, but I think I would tend to go with the general view that possibly we are closer to the bottom than we've clearly crossed the middle, and we're probably closer to the bottom than we were in the last probably 2 years.
But why do you believe that? I mean, is it because the corporate commentary on con calls sounded a lot more believable than what it has been? Because the common question that almost every PSU bank manager has been asked thus far, I mean, to Jay Kumar of Bank of Baroda as well, right? That for the last 2 years, you've been saying that we're very close to the pain points getting over. Some of it hasn't happened. And every quarter, I remember at least one report saying that, yes, the worst is behind us. Somehow it doesn't turn out to be the case. So what gives you the confidence this time around?
No, I think it's also the, if you look at the NPA profile across sectors, I think, we're probably largely behind the curve, or I would say, or the steel we're largely behind the issues on the metals and mining sector.
Sure.
I think the big exposure that people were looking at were on the power sector. And we've done our work on the power sector. There's probably a little bit more, but if you look at the power NPAs as a percentage of the loans outstanding on the power sector, I would think anywhere from 30 to 50% of the power exposure have already been recognized as NPAs. Right? These are, I'm talking of the non-PSU loans. Because I would say non-PSU includes maybe loans to even some of the the PSU financing companies as well. So if you exclude that and just look at private sector loans, then I would, our view is that anywhere from 30 to 50% of the loans exposed to those sectors have been recognized as NPAs. right? So that gives us clearly much bigger confidence. Now, whether there's another 20%, 10%, but clearly, we're almost crossing the midpoint of the exposure on the segment. So that was a big problem sector as we analyzed. So as I said, metals we are probably largely behind. Power we are slowly leaving it behind us. Now I don't know if any other sector comes up and creates a problem, but as it stands now, I would think or our view is that maybe 1 quarter more and we are probably done with a large part of recognition of the issues in the sector.
Interesting. Okay, so then in which case, what's the earnings outlook for banks? Let's talk about that because that's the biggest one, right? Based on what you've seen in FY18 and the kind of base formation that happens, though I think the base has virtually stayed okay for private banks.
Yeah.
How does FY19 come about?
No, I think if you leave out talk about the retail financials, I think, probably steady, right? The corporate banks, we are expecting obviously a big rebound in FY19. In fact, a bigger rebound in FY20, right? So I think there's no reason not to believe those numbers at this point in time. So we would, so in fact, if I look at that, as I said, the consensus earnings expectations of 15 to 20%, or I would see even numbers are extending to 23% YOY growth for FY19. The biggest drivers are your banks, your metals and oil and gas.
Okay. So that's as far as banks go. I mean, I'm just extending this. Yeah, NBFCs, sure. You believe this whole talk of the rising rates, etc., and that certainly seems to be a given in this year, maybe even the next one. Yeah. NBFC's cost of borrowing could go up. Could the Goldilocks scenario of sorts come to a bit of pause, or do you believe the lending cycle is strong enough for them to continue making the money?
So this has been one of our most overweight sectors for the last 4 years, I guess, for a large part of the street as well. And I remember at the beginning of the year, these worries had come back, because you were looking at a rate increase scenario globally, not just in India. We stuck to the theme, basically saying that, the volume growth in the sector will be so good that, that will take care of the increase in costs as well. We're continuing to stick with that thesis.
Okay. How did you analyze the earnings of let's say autos? Let's start off with that. High frequency indicators of sorts. The numbers looked okay. The earnings, at least what we tried to analyze in the morning, seemed to suggest that a bunch of companies had some issues, real issues this time around in the earnings delivery. Were you of the same opinion? And what would your thesis be for earnings growth in FY19?
No, I don't think we had particularly had any issues on the auto sector. I think they were
Tata, JLR, Eicher, etc. No.
So I don't want to get into company specifics, but I think broadly, except for the first company you mentioned, where I think we try to always take it out of the earnings discussion because there are a few one-offs from time to time. But I think broadly the auto sector, I don't think there were any particular issues with respect to auto sector. I think we were expecting about if you exclude the company, we're expecting about 20% YOY growth. It's come at about 19% YOY growth on profits. So clearly no big issues in the auto sector.
At the moment the juggernaut continues, you think?
Yeah, so I think for the time being, yes. I think one will have to watch the CV cycle a little more closely because there have been other drivers for the CV cycle because they were coming off a very low base for about 6 to 7 months, and then you had this overloading ban issue, helping CV volumes in certain large states in the north. That's probably one cycle to track, but even there, our belief is that the replacement cycle will help sustain a double-digit growth in FY19 as compared to last year. While the base begins to look unfavorable from August onwards, I think the replacement demand should be pretty strong. So we are still sticking to our large bets on the auto sector.
Okay, interesting. What surprised you the most? I have a couple of other spaces that I want to talk to about, but anything that surprised you this time around, positively or negatively?
I think positive surprise is clearly on the consumer profits, largely led by a very sharp expansion in margins.
Okay, so this is in contrast to the overall earnings season, right? Yes. Because you started off saying that margins, correct, by and large came off.
Yeah, correct. Yeah, good point. I think, so this was one area where we actually saw, good margin expansion, not completely unexpected, but some of the companies actually beat our expectations on margins as well. While the overall revenue growth were largely in line, but I think the margin growth clearly was a surprise. And So you actually had a pretty strong beat on the consumer profit number, which is a large sector at the end of the day from a broader India perspective. So if I look at the companies under our coverage, I think the consumers actually profit growth was almost 19% YOY, versus a 15% kind of expectation.
Okay.
So that was clearly a positive surprise, very clearly a positive surprise to us.
How does that set us up for FY19? Because the base obviously won't be low. The volume growth numbers, especially Q3, Q4, picked up well.
Yeah.
Somebody that was speaking to us just moments before you came in mentioned that technical triggers like the GST rate coming off will probably ensure that volumes anyways stay higher because of the elasticity factor. And then you got to see whether the unorganized to organized shift also works favorably. What is it that you will be working with?
Yeah, so I think clearly the volume growth led by partly the GST led price cuts. Unorganized to organized has played out in a few sectors, has not played out in a lot of sectors that people were expecting.
Yeah, but staples in particular?
Staples, there's really not much of that unorganized to organized shift as we can see. But I think what will also support staples could be, we are pretty bullish on the rural sector for FY19. I think from that perspective, the volume growth should sustain in our view in FY19 as well.
Okay, so since you started off on that theme, let me ask you, how was, maybe not just the last quarter, but the last 2 or 3 quarters, rural is probably a theme that stretches out.
Yeah.
How was the last year for rural, and what is your preferred mode of playing the rural space in FY19 from an earnings perspective and then maybe a valuation perspective?
Yeah, so I think rural numbers were pretty strong on the discretionary financials and also on the staples, right? Our preferred mode for FY19 will still be if you were to build a rural portfolio, I think I would give a larger weight to discretionary and financials and then to staples.
Okay. There was, how do I say, some bit of mismatch or, some bit of variance that we saw in what the expectations were versus what the delivery was on a lot of these consumer durables, right? But air coolers, for example, got decimated because of weather concerns. Similarly for air conditioner segments as well, select pockets didn't do well. Consumer durables, at least the listed space, what do you believe? Because again, the whole unorganized to organized hasn't quite helped them meaningfully in the second half of FY18. So therefore, the base is not as unfavorable as what would have been. Yeah. How did you analyze the numbers? What is your expectations for FY19? It's not a very large pocket, I know, but still.
No, I think so. Consumer durables ex autos, right? So I think clearly within that, electricals seem to have held up and have reported reasonably strong numbers. A lot of the others, when you look at the tiles and plywood, etc., I think they have been massive disappointments. I think in that possibly that unorganized to organized shift, plus what is also essentially a weak real estate market is probably not helping. One big driver that we saw for electricity, it's a theme that you should probably run a special series on at some point in time, is clearly on how the increased power availability in UP, Bihar, etc., are driving sales of electricals. Because if you look at last 3 years, the CAGR for electricity consumption growth in UP and Bihar have been double digit growth. If you include MP also, it's still double digit. Well, if you look at the all India number, excluding these three, it's probably 3 to 4% CAGR.
Interesting.
Right? So I think, when we went around, we have a series called Rural Safari, right? So when we went around...
I love those reports, by the way.
Yeah, so when we went around doing that, we actually saw, our gentleman who does this more regularly happens to be from Bihar, and, he was telling us that, he actually started seeing induction cooktops in rural Bihar, right? That's largely because of the availability of electricity. You probably always had a wire going through, but you now have electricity for 18 hours and 20 hours. So that's actually a big theme which we are driving. So, and it's also reflected in the numbers which have come through on the electricals. So the electricals consumer durable companies have actually reported strong numbers.
Interesting. That's very, very interesting. Yeah. Okay. Any other such nuggets?
We'll talk about it in detail later.
Maybe later on. Paucity of time, but let's talk about a couple of pockets here. We haven't talked to you about cement at all. What did you make of the quarter? And how does FY19, FY20 look like? Some of your peers are factoring in that FY20 will be that year of big meaningful growth in cement volumes. What are your thoughts?
So I think, before we talk about this quarter itself, specifically on cement, what we've seen over the years, cement always starts with very high expectations, and it's a sector which have actually consistently seen earnings downgrades every year for the past 3 years. It's happened in other sectors, banks and otherwise, but those are all NPA led. But cement also, we've seen that kind of a number. And secondly, cement stocks always, in the last 3 years, have also tended to trade at a premium to its history. So on one hand, you had an earnings downgrade, and then you had a valuation which was trading at a premium to history, so which never really helped those stocks. A lot of cement stocks are actually flat when you look at from a 3-year basis, even some of the large cap names, right? So this quarter, incidentally, from a EBITDA level, vis-a-vis expectations, it was not so much of a disappointment. PAT level, there was disappointment, but probably the quantum of disappointment has actually declined this year compared to the previous quarters. Having said that, I think FY19 and 20, again, as you rightly pointed out, in FY20 there is a fairly sharp improvement in profits which the market is expecting. Okay. So we have it in our numbers as well. But our cement analyst had put out a very good report where he had highlighted that the expected pricing power that the sector is looking at as capacity utilization improve, that's probably not going to come out that fast. It's probably going to take time because there's still a lot of capacity being planned and probably coming up in the next 3 years, which will actually continue to put a pressure on cement prices.
Interesting. So, and of course, we can't get down to talking about all the spaces. I know I haven't asked Suhas about IT at all, but having said that, looking at all the variables that have happened and how Q4 has happened as well, you gave us your base case of what you expect the earnings growth numbers to look like for FY19. Do you believe the recovery in earnings, if I can use recovery as a term loosely, will it happen, would it be back-ended, or would you believe there would be a higher chance of we starting seeing these numbers Q1 onwards itself?
No, as you rightly pointed out, I think banks tend to be a big driver for these earnings growth, right? So the 3 sectors which are expected to drive earnings growth in FY19 are clearly banks, metals, oil and gas. So banks is clearly back-ended. Yeah. So I think that will determine, how the trajectory goes, for the rest of the year, because those tend to be big drivers for the earnings.
Okay. So, and lastly, what's your big earnings bet? I'm not getting into the valuation bet, and therefore this is not in that space that you are necessarily recommending to your clients. But what's your big earnings bet? What is it that drives the biggest earnings growth? You mentioned banks, metals, and oil and gas. That's the standard expectation. Anything else where you are anti-consensus, wherein you believe that numbers will pick up, even it may be a small space as well?
No. I think as we discussed, I think there are a lot of concerns around NBFCs, housing finance companies, right? I think we continue to be fairly bullish on the NBFCs and private financial space. And I think, as I said, at the beginning of the year, there were a lot more concerns, but we continue to stick to our bullish stance on that space.
Okay. Well, Suhas has left us with a bit of a teaser. Remember, he spoke about this very interesting statistic of power growth in UP, Bihar and some of the others versus the rest of the country over the last 3 years. But it also leaves us a teaser with some more interesting discussions with him, possibly over the course of the next couple of months as well. So we look forward to that. And we are out of time completely on this show. Suhas, thank you so much for taking the time out and being with us on this earnings conversation. Really good having you.
Thank you.